around throughout the nation, and we can get back to business. What you see here is the trade scalper on the chart. I'm going to add here a few things. I haven't seen what the markets look like this morning. Like I said, I was trying to update here the computer. So let's first start off with the Atlas line. Let's see where that gets us. Okay, so the Atlas line is indicating short, right? So what we're seeing here is short here because the market is trading below the Atlas line. We're going to focus on short trades, and not that you can't go long, but it's a good idea to have most of the methods that you're looking at indicating in one direction or another. So in this case, if you are going to scalp the market to the short side, you have a little bit of extra evidence that short is the way to go until and if this occurs, it begins to trade above the Atlas line. This pink dashed line is the Atlas line that's plotting. And once the market trades above that, then it would be okay to go long for the Atlas line trades. So what you have here is the shorts, short on the scalper, and these P's and these S's are indicating pullback and strength trades. So these are additional trades that are indicating we're going short. The market's pulling back, go short. The market is giving us strength, let's go short. And as I pull up here my email at the same time, I see that there are a few people that indicated they were trying to get into the room. So let me just email back and say the room is open. I think I have here Jen's. So that's what we have. Now let's take a look at the open method. So if I add here the at the open strategy, we're going to see the signals. Like I said, I have not seen these signals for today as of yet. And then we'll move on. Once we see these signals, we'll move on to teaching you something. I want to show you the ABC method, so make it worth your while so you actually learn something in this presentation. So we have here an ATO short. I'm going to remove here the Atlas line to show you the at the open method a little bit clearer for today. So the at the open method is indicating to go short at 27.74.75. Again, remember, I like to look at a few different things as far as targets and stops. With the at the open method, I'd like to look at the ATR. The average true range is indicating about 4 points, 27.74.75. To go short is based off of price action, time, as well as movement in the market. There's no indicators that we're looking at, and so 4 points is what I can expect on the at the open method. So 4 points within the next few candles. The market went 3 3/4 of a point. Remember, by the fourth candle time-based stop, I think it's a good understanding that we should be out of the trade as well. So you don't hold on to these trades for hours on end. As a day trader, we want to be in and out as fast as possible. And if the market's not going in your favor, if it's not moving in your favor, you should definitely exit. You shouldn't hold on to losing trades. We look for the next opportunity. So that's the at the open method for today. Using the ATR as a target as well as a stop, right? I have hundreds of videos explaining the targets and the stops and the ATR if you want to learn a little bit more about that. But that's the at the open. And the same thing if we look at the scalp, the trade scalper, we have many more signals on the trade scalper, but they're smaller targets. So I'm not looking at the ATR as a target on the trade scalper. I want a very quick entry, and I want to immediately be out of this with a profit. So we're not looking for the full ATR on the trade scalper. A couple of points, you're done. On to the next trade. You got it, Gary. You're welcome. All right, so that's the at the open method. That's the trade scalper. Hopefully we'll get a few more signals I can show you live as this is happening as well. That way you can get a good understanding of the software, what you can expect. Remember, trading is not something that we can guarantee profits. It's like a button that says I'm making money on every single trade. Just be careful. You have to look at the bigger picture. If the market's too volatile, remember to step back a little bit, wait until it slows down, or trade less. If the market's too slow, it's actually the same thing. The situation where the market was so slow the last few years that I look at anything less than 1 point or 4 ticks. If you're looking at different markets, 1 point on the E-mini S&P or 4 ticks on most markets would be the situation where you would say, I'm not going to trade because there's a lot of flip-flop and whipsaw. It's too slow. It's choppy. So you have to be careful, not only when it's too fast, as we've seen it last couple of weeks, but also on the flip side when it's too slow. Anyone have any questions for me? Gary, okay with that? Mark, Steve, Evan, Key, Peter? All right. So what I'm going to do next is I'm going to show you and teach you something on breaking up the day into 3 sections. I like to call this the ABC method because I'm breaking up the day into 3 parts: the A part of the day, the B part of the day, and the C part of the day. And let me just add the Atlas line back so you can see if any signals occur in the Atlas line. You can see that as well. Okay. So what we're looking at in breaking up the 3 parts of the day, I'll just put this like this, is looking at a situation where the first 2.5 hours of the day is typically the most volatile, where the action occurs. It doesn't matter if it's the E-mini, the Dow, the NASDAQ, the Euro, the FTSE, the DAX. Really what we're looking at is the initial start of the day with all of the buyers and the sellers jumping in. So I call that the A part of the day. And typically, if we're looking at typical markets, it's 2.5 hours. And I also believe that you can trade this on the crude oil and other markets, but you may have to adjust these time frames separately because 2.5 hours on the E-mini starting at 9:30 New York time is a little bit different than starting on the crude oil or on the bonds or the treasury notes, T-notes. So you have to just adjust it slightly to break up the market that you're looking at or the session that you're looking at, whether it be the London session or the Asian session, into 3 sections. So the A part of the day, typical equities, E-mini, Dow, NASDAQ, is 2.5 hours is the A part of the day. And then we have the B part of the day. The B part of the day is also 2.5 hours, but this is typically slower. And the idea is that the B part of the day is lunchtime, or the B part of the day is when the market begins to slow down. The traders that are long or are short are already in a trade. They're not going to trade more, buy more, sell more unless they need to or have to. So the B part of the day is typically a lull where whoever's in is already in the market and now they're holding on to a position, maybe swing traders, day traders, but they're holding on to a position. And what you typically see is the market slow down. That's a typical price action concept, that the middle part of the day slows down. And then what we have last is the C part of the day. Now this C part of the day is a little bit slower as we get into the close, and it's not 2.5 hours. It's typically an hour and 45 minutes. Again, adjust for the markets that you're looking at. And the C part of the day is as we get into the ending part of the day. Traders are looking to exit. They're looking for the market to make a move, and you may have late day rallies or late day sell-offs as we get into the close of the session. And that's based off of earnings. That's based off of news. It could be the FOMC in the afternoon. So the C part of the day, we can also have opportunities based on what occurs as we get into the close. So in order to break this up, the A, B, and C, we have to look at it visually on the chart, how that looks. So what I'm going to do here, I'm going to remove here the Atlas line so it doesn't clutter our charts. I'm going to go to yesterday, and I'm going to show you the ABC as well. And what it looks like, if you're looking at the London session here, for example, is manually, I do have software, and I do provide the software for traders. It's called the ABC software. Some of you may already have it as well. So it's called the ABC software, where it does this for you automatically, but manually it's very simple to do. And you can do this manually. You don't need the software. So 3 o'clock to 5:30 would be on the E-mini S&P in London, local time, where you would have the A part of the day. So it looks like this. This is the A part of the day. And then as we get into the B part of the day goes from 5:30 to 8 o'clock, like so. And then we have the C part of the day, which is, again, a little bit slower or less time, an hour and 45 minutes, is right here. So what I'm doing is not just looking at the US Open, but I can trade this method in the London Open as well, which is 8 o'clock locally in London. So this is the C part of the day, like this. So the goal here with the ABC is to say what happens here, what happens here, and what is happening here. And if we understand what's happening in each of these sections of the ABC, we can understand the market a little bit better. We can say, do we have a trend, or is the market flip-flopping, or is the high of A and the low of A creating support and resistance? Because many times the market tests the high of A and the low of A, and it acts as support and resistance. The same thing with B. Is it acting as a breakout, or is it acting as support or resistance when the market is beginning to trend? So this is how I like to use the ABC. Do I have an opportunity as a trending market? Do I have an opportunity as hitting support and bouncing off of support, or bouncing off of resistance and taking a trade in that way? That's a great way to look at trading this method. So when I look at this here, the rules of how to trade the ABC method, and the software will give you the signals as well, but the rules for it is basically to say, when we have 2 consecutive candles breaking out, below the low of A or above the high of A, that typically means that the market will trend higher or trend lower. The same thing is true when we have the market breaking by 2 consecutive candles below the range of B or the high of B. We have a trending market as we get into a late day rally or a late day sell-off. So I'm looking at the A and comparing it to B, and I'm using the B section of the day and comparing it to C. Now what this looks like, to look at this a little bit easier on a 5-minute chart with less candles, and let me remove here some of the softwares because it looks starting to get cluttered as well. So I can show you just this here. So what this looks like is this, nice and clean. We're looking at the A part of the day, which is right here. This is, again, the London session as an example, and I'll show you the US session as well. And remember, forget about the E-mini S&P. It could be any market that you trade. The E-mini is what I prefer, but this is universal. It doesn't have to be the E-mini. It could be the NASDAQ, it could be the Euro, it could be anything. So in the A part of the day here, what I'm looking at potentially is 2 consecutive candles closing either above or below the range of A, which is this and this. And again, if the market doesn't close by 2 consecutive 5-minute candles below or above, it's bouncing off of it. You have to think of that. These are acting as support and resistance. So as we go further here in time, you see the market reached this and bounced off of it. It's a common price action theme that this occurs. You can call it double bottom, double top, whatever the case may be. We're using the reference of the first 2.5 hours to dictate what happens in the B part of the day, which is this here. Now, when this occurs, you have an opportunity to buy it. And if I add the software, the ABC software, it does give you that bounce as an opportunity to buy. But I also think that if you're using, see, it's the DayTradeToWin ABC method. If you're using your own methods, or if you're using one of the DayTradeToWin methods I offer, use that in conjunction. Say it's bouncing off of the range low here of A support, and I'm also getting a scalper entry to go long. I'm also getting an Atlas line entry to go long. So now you're combining and you're saying, I expect the bounce to occur and I have a signal. Great. That's exactly how you should be thinking of trading. Not just, one bounce that's going to make or break a trade. See if you have something else that confirms that as well. So if I add here the ABC, the only thing I have to change is the start time because I'm using the London session. It's 3 o'clock because I'm Eastern Standard Time, correct, right? So that's what it looks like. And so now what we're looking at is the market giving us this area to tell us to buy or to sell. And it's again based off of, will the market show us the market breaking or bouncing off? And that's why you see here the ABC long. It's hitting the support of B and then bouncing off of it to go long. Steve says here, does ABC software come free with the Trade Scalper, as I have purchased that? I believe that the ABC method comes with, let me just take a quick look here, with the at the open method, I believe. Let me see, Steve. It comes with the at the open. I'll send you the link for it. But I usually offer it as a bonus with the ABC, and it's included with the mentorship as well. All right. So what we have here is the ABC giving us these signals. Now, this is just for the London session. If I update this to the US session to 9:30, and I look at yesterday, this is yesterday. It's the same thing. You see here how this is the A part of the day beginning from 9:30 to 12 o'clock. It's 2.5 hours. Again, from 12 o'clock to 14:30, which is 2:30, again, 2.5 hours. And you can color code this, correct, right? The yellow that I have shaded is what I have as the colors. But you can color code this, or you don't even have to shade it if you don't like. I just have it that way. And so what you have here is the A part of the day being this high and this low. And at no point did the market break above or below here by 2 consecutive candles. Now on the top side, you see that it hit the resistance of the high of A, right? This is the A part of the day. And it bounced off of it. That presents an opportunity. And that's why you see ABC short 27.7850. The exact reason for that signal, if I move this out of the way, is the closing price of this red candle. So let me show you exactly how the signal works, why you're seeing that entry. When this candle closes above the range of A, it's in essence like a setup. It's setting itself up. Maybe there'll be a second consecutive candle, but instead of giving a second consecutive candle to say go long, we're in a trend, instead what happens is the very next candle comes down and closes back below the range of A. So it's almost as if it's hitting the resistance and then getting smacked back down and coming back down. And the closing price of that red candle is 27.7850. And that's the reason for the signal, 27.7850 right there. And you can push the signal out of the way. Here I have it actually right on the signal offset. You can push it off out of the way so it doesn't clutter your chart. But that's the reason for the signal. Okay, like that. And the same thing is true when you have 2 consecutive candles closing above here in the range based off of the B part of the day. This is the C part of the day. You have 2 consecutive candles closing above, which is 1, 2, above the range here of B. And so that's the reason for that signal. 27.8750 is this closing price of this red candle right here to go long. Now, obviously, you can see that this didn't go long. It went long a little bit, right? 5 points, but it didn't go long more than that. Now, I'm not suggesting that you want to take 10 or 20 points, but if you're able to take something out of this trade, great. If not, leave it alone, get out of the trade, and move on. And the same thing you see, once it did not follow through, it started to come down. It's just hitting the resistance created in B. Let's take a look at another example. If anyone has any questions, please let me know. Or if there's a certain day you want to see, let me know. I'm happy to look at that day as well. So this is the previous day. This looks like it's Monday, I believe. And so this is the A part of the day right here. This is the B part of the day. And this is the C part of the day. Now, the best entries that I found are the entries that happen sooner rather than later. So in addition to everything that you're seeing here, if the market is beginning to break out 1205, 1210, 1215, right within the first, let's say, 4 or 5 candles, as we get into the lunchtime or the B part of the day, that's a really strong trend. That is something that you should want to get in on. If it happens later on or towards the end part of B or the end part of C here, that's typically not as good. So the best trades that I find are the ones that happen almost immediately, as if the resistance and the support aren't holding or nobody is stopping the market from bouncing off. It's just pushing, pushing, pushing harder. So this is something that you want to take advantage of. I would say about 75% of the time, the market respects this high, an A and low of A for a bounce. And that's the low right there on that wick. About 25% of the time, we have trends, and that's what you're seeing. So I would focus not so much on expecting a trend every day. I would instead focus on the support and resistance bouncing off of these high and lows of A, high and low of B, to see if it's happening and then taking a trade. So for example, here, I see the market, this is the high right here. I see the market trying to hit this high right over here, the high of B, trying and failing multiple times. This is not going to break out as a late day rally. It's only as we get into this later part of the day in C that you start seeing a signal. And I think that the trades are much better when they occur right in the beginning, closer to 12 o'clock and closer to 2:30 as these ranges are setting up. Let's take a look at another example as well. Same thing, you see this is the range of A, high and low. This is the range of B. And only towards here, the end of the C part of the day is when we start to have, right as we get into the close, the rally. So I don't think going long right as we get into the end here is as good as soon as we get into 2:30. This is when the FOMC begins to release their meetings and their minutes. Right as this happens, this is when you want to see the rally or the sell-off, as well as right at 12 o'clock, 12:05, 12:10. Right within the first 4 or 5 bars, you should see it. So only after it breaks that, we say there's a trend. If it bounces off of it, which it did in this case, then we see a support and resistance move. You can take advantage of that. All right, let's take a look at one last example here, just going back in history, and then I'll switch back to the trade scalper. Okay, this is the previous day as well. So this is an example of the high of A and the low of A being respected here. Now I'm going to just expand this chart because I can see there's a lot of candles, so we can get a good sense of what's happening. This is the high of A. I'm going to put a line here. High of A, this. And you can see that it tagged it and bounced off of it. So it's hitting resistance. Closed above and then closed right below. And so this candle, this red candle right here, is the reason for this signal to go short. Closed above, closed back below. Again, it closed above and then started to close back below. So this is the reason for the signal. The sooner it happens in B, the better. Now you see here in ABC short, this trade you can see is a losing trade, but the reason for the trade is 2 consecutive candles closing below and the signal appears. So this trade did not work. It's a losing trade. This would be the entry to go short, and immediately it reversed. This trade did not work. Instead, it came right back in. But have a good understanding and a concept of what you're seeing. A, B, and C. If you start to see it break out, you have an opportunity. If you see it bounce off of it, you have another opportunity. All right, let me go now into the future. We'll remove here everything off the chart. Let me add back to see where we're at. And I'm going to switch to a 1-minute chart as well. Okay, there it is. So here we have a long signal. Again, I would say I'm avoiding the long signals because we're still below the Atlas line. Really only when it begins to cross and penetrate the Atlas line, I can say, great, market's going up, we're changing direction, and we're now focusing on long trades. The same thing is true after 12 o'clock here. If the market continues to rally, look for, based off the ABC method, 2 consecutive candles closing above or below right here. That's the range created by the A part of the day. One last thing I'm going to show you, because I know some of you are asking for the roadmap. So I'm just going to remove this here. And that way you can see the roadmap, which is included with mentorship. That this software indicates where the market will reverse. It's based off of, again, price action. And what we're looking at as this is calculating, areas to avoid buying and areas where we're avoiding selling. And so this, while this is calculating, okay. So with the roadmap, this indicates not to go short once it lands in the zone. This indicates to be careful not to go long when it lands in the zone. Same thing is here. Be careful not to go long only after it surpasses it. Same thing here. Be careful not to go long when it hits the zone. The same thing here. So it calculates this for you in advance. And it does give you signals as well to buy or to sell based on counter trend. So if it hits here, it's going to say time to go short once it hits this area as it's bouncing off of it. So that's the roadmap indication, indicating it's a filter. Be careful not to go long once it hits here. Be careful not to go long once it hits there, and so on and so on. It just does this, it plots this all day long as a filter. So if you're long, just be careful. The market may begin to, and the way that this works, this roadmap is based off of buyers and sellers. Once it hits this area, there's profit taking that occurs, and the profit taking is going to stop the market from going higher. Traders are going to take their profit and cause this opposite reaction. And that's the reason when traders think of indicators like MACD and moving averages and that type of indicator-based methods, it doesn't take into account outside influences. And there is an outside influence. When there's a huge amount of sellers taking profit, it affects the market, influences the market. And that's the purpose to the roadmap. Where traders take profits, it's going to cause a reaction, an opposite reaction. So if you bought right as the market lands in the zone, if you bought, there may be a lot of sellers taking profit, which will run you over. And that's what this is right here. And if it comes here, be careful not to go long around 27.81 because there's going to be profit taking, and then the market will bounce back and run you over if you were long right as it hits. After it hits, the profit taking is over, and it continues, it's different. It's done. It's moving on to the next level, next roadmap level. So that's what you have to be careful with as a trader. Know where profit taking occurs and avoid trading against that. Anyone have any questions for me? Sorry for the late start. Again, I'll put up this video on the YouTube and on the DayTradeToWin blog and the videos page. If anyone is interested in joining the next mentorship class, it's April 28th. All the software is included with lifetime licenses. Email me or call me if you have any questions. Let me know if everyone is good. Alex says here, do we have to take into consideration that the candle is approaching to a previous R support or resistance, or is it shooting star when we see the signal to buy or to sell? So let me just see if I can forward this to everybody, right? Yes. If it's approaching support and resistance, you should take that into consideration.